Hey seniors, glad you are here. In this video, I'm going to show you 7 things your bank knows about your account that it is legally required to keep from you, and the one instinct that turns completely clean savings into a federal criminal case. Your bank has been given legal authority to report your cash transactions to a federal agency without your knowledge and without your consent. There is a specific dollar amount that automatically triggers that report. There is a second report that can be triggered on any amount regardless of size. And there is a rule passed specifically for seniors that gives your bank the power to lock you out of your own money for up to 15 business days, without explanation. You agreed to none of this explicitly. It was not in the brochure when you opened the account. It does not appear on any statement you have ever received. Here is what makes this dangerous for honest people. The report itself causes no harm for the vast majority of seniors. It is processed quietly and nothing follows. What causes the damage is the reaction, the instinct that kicks in the moment someone learns the rule exists, because that instinct is exactly what converts a lifetime of legitimate savings into a federal investigation. 7 rules, all of them operating right now in 2026. All of them affecting your account whether you know about them or not. The last one is the decision that has cost more senior families more money than the other 6 combined, and it is almost always made with the best intentions. Stay through to the end, because the final thing in this video takes 10 minutes at your bank branch and eliminates the risks from almost everything that comes before it. Smash the like button right now, not at the end, right now. Because every tap gets this in front of one more senior whose bank is running federal reports on their transactions and cannot say a single word about it. One tap. Do it. Subscribe and flip the notification bell. The banking rules affecting seniors are changing in 2026, and your bank has no obligation to update you when they do. The people here find out before the rule costs them. The ones who are not tend to find out after the account is already frozen. Rule 1. The $10,000 threshold. A federal law called the Bank Secrecy Act has been in place since 1970. Under that law, every bank and every credit union in the country must file a report called a currency transaction report. Whenever a customer makes a cash deposit or withdrawal of more than $10,000 in a single day, the report goes to the Financial Crimes Enforcement Network inside the Treasury Department, not to the IRS, and not to local law enforcement. Your bank prepares it and submits it. You are not involved. You do not sign it. You do not know it was filed. The bank has 15 days to send it in and keeps the record internally for 5 years. In practical terms, this report is almost always completely uneventful. Millions are filed every year. The overwhelming majority of them are processed and nothing happens. No phone call. No investigation, no account action. If you receive $12,000 in cash from the sale of a vehicle and deposit the full amount, a report gets filed, and your life continues without interruption. That fact is important. Hold on to it, because what comes next is where people who have done nothing wrong walk directly into a federal felony. Rule 2. The mistake with a name. The moment most people hear about the $10,000 rule, for the first time they arrive at the same conclusion. They will keep transactions just under the threshold. Deposit $9,000 instead of $10,000. Split a larger amount into several smaller ones spread across multiple days. It seems logical. It seems cautious. It is a federal crime. Under Title 31 of the United States Code Section 5324, the deliberate practice of keeping cash transactions below the reporting threshold to avoid the currency transaction report is called structuring. Structuring is a federal felony. The punishment includes up to 5 years in federal prison and financial penalties reaching $250,000. Beyond that, the government can seize the funds involved through civil asset forfeiture, a process that does not require a criminal conviction or even a criminal charge. The part that has destroyed ordinary retirees is this. The source of the money is irrelevant to the charge. Every dollar can be completely legal. earned honestly over a lifetime, left to you by a spouse, given to you by your children. It does not matter. If the pattern of transactions looks like an attempt to stay and stir on the reporting line, the offense has been committed regardless of where the money came from. There are real documented cases of retirees and widows whose entirely legitimate savings were taken by the government through civil forfeiture simply because their deposit behavior matched the structuring pattern. Your bank watched those patterns develop over months. Your bank said nothing. Under the same Bank Secrecy Act that created the reporting requirement, your bank is prohibited from tipping you off that your transactions have attracted scrutiny. The law that created the surveillance also created the silence. The protection is one straightforward rule. When you need to deposit or withdraw a large amount, do it as a single complete transaction and bring documentation showing where the money came from. A sale receipt, a legal settlement letter, an estate document. The report will be filed. That is fine. The report is harmless. What is not harmless is the pattern of smaller transactions that looks like an attempt to prevent the report from being filed. Send this video right now to one senior you know who handles cash regularly or who has recently come into a larger sum of money. Not after you finish watching, right now. The structuring law has no requirement that the money be illegal. It only requires the pattern. Rule 3. The report with no minimum. Beyond the $10,000 currency transaction report, your bank has access to a second reporting tool that has no dollar threshold at all. It is called a suspicious activity report, and a bank can file one on a transaction of $500, $200, or any amount if the automated monitoring system determines that the transaction looks out of place for your account. No minimum, no floor, no size requirement. The trigger is not the amount, it is the deviation. A transaction that breaks from your established pattern is what activates the flag. If you have withdrawn the same modest amount every week for 15 years and you suddenly ask for several $1,000s, the system notes the departure from your history. It does not factor in that you are paying a contractor. It does not factor in that a family member needed help. It flags the deviation and a report gets filed. And under 31 United States Code Section 5318G, your bank is legally prohibited from telling you that a suspicious activity report has been filed on your account. The filing is confidential by federal law. You could have a report filed against you today and have no legal means of discovering it. Your bank knows. Federal regulators know. You are specifically excluded from that knowledge. The defense is documentation. Anytime a transaction deviates from your normal pattern, bring paperwork that explains why. A contractor invoice, a letter from a family member, a closing document from a property sale. When the paper trail matches the transaction, the flag resolves quietly. When it does not, the flag stays open. Rule 4. The 15 business day senior freeze. Over the past few years, banks and investment firms have been granted specific legal authority under FINRA Rule 2165 to place a temporary hold on the accounts of customers aged 65 and older, whenever the institution suspects that senior may be the target of financial exploitation. The hold can remain in place for 15 business days, 3 full calendar weeks, and can be extended beyond that if an investigation continues. The intention behind the rule is legitimate. Scammers target seniors. Accounts get drained before anyone notices. The temporary hold was designed as a protection. The reality in practice is that a senior who walks into their bank branch to withdraw $20,000 for a completely legitimate purpose, helping a grandchild with a down payment, lending money to a family member, paying a contractor for a major home repair, can be pulled into a private office asked to justify the withdrawal and prevent it from accessing their own money for days or weeks, while the bank determines whether the transaction is voluntary. There is no argument you can make at the teller window that speeds this up. The way around it is to get ahead of it. Before any large or unusual transaction, call your bank and describe what is coming. One sentence, the purpose, the amount, The date. That call creates a documented record that the transaction is expected and intentional. Also, ask your bank to add a trusted contact to your account, a family member they can reach quickly to confirm you are acting freely. Most freeze extensions happen because the bank cannot reach anyone to verify the account holder's well-being in time. The trusted contact removes that obstacle before it becomes a 3-week wait. Rule 5. The $250,000 line. Every account at every FD member bank carries insurance coverage of up to $250,000 per depositor, per institution, per ownership category. If you are holding more than that in a single account at a single bank and that institution fails the amount above $250, 000 is uninsured and can be permanently lost. Bank failures are not a historical footnote. In 2023, 3 of the largest bank failures in American history occurred within a period of roughly 10 weeks. Depositors under the $250 0 threshold were fully protected. Those above it were at risk and were only made whole because of a government decision that no law requires anyone to repeat in the future. The fix costs nothing. Spreading balances above $250, 0 across multiple institutions, or across different ownership categories at the same bank, brings every dollar back under the insurance umbrella without affecting your access or control. Rule 6. The joint account. At some point after a spouse dies, someone will suggest the practical solution is to add one of the children to the bank account. They can help manage the bills. The money will pass to them easily when the time comes. It sounds like a reasonable simplification. The moment a child is added as a joint owner, that money is legally half theirs right now. Not eventually. Today. Which means, if that child goes through a divorce, the account can become part of the divorce proceedings. If a judgment is entered against them in a lawsuit, a creditor can pursue the funds in your account. Because your child is a legal co-owner. If they owe back taxes, the IRS can place a levy. If they file for bankruptcy, the account is exposed. Any single child named as joint owner can withdraw the entire balance without the knowledge or consent of any other family member. And because a joint account typically transfers automatically to the surviving owner, it can quietly override the distribution plan written into the will passing everything to one child, instead of dividing it among all of them as intended. The decision made out of love and practicality can deliver the savings of a lifetime to a lawsuit, a divorce, or a tax levy that has nothing to do with the parent who built it. Rule 7. The 10-minute fix. Instead of a joint account, ask your bank for a payable on death designation, a POD. The mechanics are the opposite of everything that makes a joint account dangerous. You remain the sole legal owner of the account for your entire lifetime. The people you name have 0 access and 0 ownership while you are alive. No creditor of theirs can reach it. No divorce proceeding can include it. No lawsuit can touch it. The moment you pass away, the account transfers immediately and directly to the named beneficiary, without probate, without a court proceeding, and without legal fees. It does everything a joint account was supposed to do with none of the exposure that makes a joint account dangerous. It is free. It takes one conversation at your branch. And while you are having that conversation, look at the total sitting in checking and savings. 3 to 6 months of living expenses, somewhere between $15,000 and $25,000 for most retirees, is the right amount to keep in an accessible bank account. Everything above that is sitting in an environment where it is being monitored by federal reporting systems, earning almost nothing and losing ground to inflation every month. Moving the balance above that level into a high-yield savings account, into Treasury bills, purchased directly at treasurydirect.gov, or into certificates of deposit spread across several banks to keep every dollar under the FDIC insurance. Limit gives you full control, full access, and a real return on savings that have been sitting idle while federal algorithms watch every transaction. Here is what runs through all 7. The $10,000 currency transaction report exists, and your bank will never bring it up. The structuring law punishes the response that feels safest when you learn the rule. The suspicious activity report can be filed on any amount, and federal law prevents your bank from ever telling you. The senior account freeze can lock you out of your own money for 3 weeks in the name of protecting you. The FDC insurance limit is a line most seniors have never checked. The joint account set up out of love can route your savings to the wrong place permanently, and the fix for most of it is available at your branch today, waiting for you to ask for it by name. None of this comes looking for you. Your bank does not call to walk you through the risks. The government does not write to explain how to keep your money safe. The system stays exactly where it is, working quietly in the background till the day you decide to move first. You now know the rules. You now know the one response that turns cleaned money into a federal case. And you know the single designation that protects everything the others put at risk. Smash the like button, subscribe and flip the bell, and send this today to one person over 60 who keeps most of their savings in a single bank account, especially someone who just lost a spouse and is about to add a child to the account because someone told them it was the simple thing to do. The odds are strong that at least one of these 7 rules is affecting their account right now, and one conversation today could save them thousands of dollars and a freeze they would never see coming.